Hello friends, hope you are all doing well and are safe. This is Pratik here from the world of financial reporting. We look to help you navigate the world of financial reporting. In the session today, we will do a quick recap around the concepts related to financial instruments. The topic is a very big and a vast topic, so we will restrict our assessment, our discussion to the concepts around what are financial instruments, the definitions, and then the initial recognition of a financial instrument. So without wasting too much more time, let's straight away get into the topic. Financial instruments, the basics. What are financial instruments? Financial instruments are resulting from a contract. It arises out of a contract and results into a financial asset for one party and a financial liability or equity instrument for another party in the contract. Let's take a few examples to get the concept clear. Let's suppose a company buys goods on credit terms from its suppliers. Now, this amount that the company owes to the supplier is a financial liability because it's a contractual obligation to pay. Whereas from the point of view of the seller of the goods, it's a financial asset because it results or it arises out of a contractual right to receive cash. So the key point that I wanted to drive home here is that this arises from a contract, and therefore statutory dues, income tax paid in advance, all of those do not get scoped into the financial instrument standard. So we just need to look at whether there's a contractual right to receive cash or a contractual obligation to pay cash. Equity is evidencing the residual interest in the entity. Financial assets also include cash, equity instruments of other entities. So for example, if one had to just run through a balance sheet of a company, on the asset side, you have items like property, plant and equipment, which are clearly not financial assets. They do not represent a contractual right to collect cash. On the other hand, assets like investments in shares, bonds, FDs, mutual funds, they are all financial assets, either because they are a contractual right to receive cash or they are equity instruments of other entities. On the liability side, you have borrowings, debentures, payables, all of them again arise from a contract and are an obligation on the company to pay, and hence a financial liability. To finally close this entire discussion around the definitions, let's take an example of a prepaid expense. A company has paid an expenditure in advance and it is sitting on the balance sheet. The question is it a financial asset or not? And the assessment once again boils down to how would that asset get settled? Would it get settled, or would it provide the company with a contractual right to receive cash or a right to receive service? And that's the key determinant. In the case of prepaid expenses or incomes received in advance, the settlement happens through rendering or receipt of services and not by settlement of cash. And hence, they are out of the scope of the standard. Having now understood what are financial instruments, let's talk about how do you recognize financial instruments on day one, that is at initial recognition. The simple rule is that all financial instruments at their initial recognition are measured at their fair value. Also, fair value is, or the transaction price is presumed to be the fair value unless there is a reason to believe otherwise. We'll look at two examples to clarify this concept. Let's first talk about the concept around the initial recognition being at fair value. On the slide that you see, on the screen that you see, there is an example which talks about a security deposit placed for obtaining a premises on lease. So the start date of the deposit is 1st April 2014. The maturity date, as you can see, is 31st March 2019. The lease deposit that's paid out is 2 million rupees. The present value factor at the end of 5 years is 0.5674. Now, the concept of fair value is very closely linked to the concept of time value of money in this example. What we're trying to arrive at basically is that a rupee after 5 years is worth less than a rupee today. And therefore, if an entity places an interest-free security deposit to get a lease premise, that financial instrument is not at its fair value. Its real fair value would have been at what rate or how much would the company have had to invest today to get the 2 million rupees at the end of the lease term. In this example, the situation that we have on hand is that there is a 2 million rupees deposit that is paid on 1st April 14. This deposit runs for 5 years up to 31st of March 19, and the settlement of the deposit also results into an outflow of 2 million. Now, if we had to fair value this deposit on 1st of April 2014, we would have had to discount the 2 million back by the discount rate factor, which is 0.5674. Because the 2 million received 5 years later is worth 2 million into the discount factor, which in our example works out to approximately. Now, if one had to journalize, how would we journalize this transaction? On day 1, I have an asset which is a security deposit, and I have paid out cash of 2 million. However, the asset that I have recognized is only this much. Now, the basic rules of accounting is the debits equal to credits. Therefore, there is one more debit that we need to plug in. Now, this debit that we need to plug in is nothing else but a prepaid rent. Of $883,000. Now, the prepaid rent is not specified in the standard. The standard gives guidance on at what value should this debit come. This, of course, is a given. The standard has left this debit entry to be decided by the preparers of financial statements for each situation separately. Now, because this is a rental premise that we are taking on lease, this is nothing else but a part of the rental being paid out to the landlord by the way of making an upfront interest-free deposit. So the idea is that the landlord takes this deposit, puts it in a bank, earns 6%, 7%, in this case 12% market interest rate, and 8,83,000 is what would have been earned by the landlord in present value terms, and that's the reason why the rental that this company would have paid would have been lower. Now remember, at the end of the 5th year, the deposit needs to go back to 20 lakh rupees. How would that work out in terms of the entries? The assessment is quite straightforward. At every balance sheet date, there would be 2 entries that would get passed. The first one would be to recognize interest income on the deposit, because it's like saying I have placed a deposit which earns 12% to me. That entry would have been deposit expense or deposit asset debit, and let's assume it's 1,20,000 for year 1, and the credit would have gone to interest income. of 1,20,000. Also, let's not forget the prepaid rent of 8,83,000 would also get amortized, for which the entry would have been rent account debit to prepaid rent. Now in this example, let's assume that this amount is 1,60,000. I am making some assumptions or approximations in this case, just so that the discussion is simpler. As you can realize, in the first year, there is a slight impact of 40,000 rupees on the profit and loss account. Over the life of this leasing arrangement, that difference would go to zero. So it's a zero-sum game over a 5-year period, but every year on year, there is some impact. Now, from practitioner's point of view, the important point to be kept in mind is what discount rates do you use to compute these workings, and more importantly, to identify arrangements like these. These arrangements are not clearly brought out, are not clearly documented. One needs to be on the lookout for these kind of arrangements. What arrangements do you typically look out for? Let's look at another example to talk about that concept. A classic example, let's look at the example and go through the assessment. Rainbow Limited has a wholly owned subsidiary, Canyons, which has recently been going through a lot of financial difficulties. Canyon Limited has approached Rainbow Limited for assistance, and seeing the longer term potential, the parent has funded 20 lakh rupees to Canyons as an interest-free loan. The loan shall be repayable on demand or after a fixed term, which will be mutually agreed upon by the two. The market rate of interest on a similar loan is 12% per annum. Now, the entries are largely similar. If you are the holding company which is given the loan, your entries would be loan account debit to bank. This would be for 20 lakhs. However, if you had to present value the 20 lakh rupees and say it's a 5-year term, you would once again have reached 11,17,000, which means there is another debit of 8,83,000 in this example that needs to be accounted for. Now, this is where it's important to assess what the relationship between the parties are. In this case, it's the holding company giving an interest-free deposit or an interest-free loan to a subsidiary, and therefore the debit goes to a deemed investment or an investment in subsidiary. Now, unlike the example where our prepaid rent was amortized to zero, this investment in subsidiary remains throughout the 5-year period as it is. Therefore, over the 5 years, this is a zero-sum game, but every year there is the accrual of interest at 12% on the loan. From the point of view of the borrower has got cash of 20 lakh rupees. Now, the key point to be kept in mind is the loan is repayable on demand. And this is another important concept that we should keep in mind, is that the fair value of a financial instrument repayable on demand has to be equal to its fair value. That is, the face value of the loan on day one has to exactly equal the fair value of the loan. And therefore, the subsidiary company in this case does not recognize a capital infusion by the parent. For the simple reason that the loan is repayable on demand, it has to be carried at 20 lakh rupees at all times. Significant practical issues or difficulties emerge in this. The first one is again around interest rates. At what rate do you discount it? practically you could find many situations where either the subsidiary does not have bank borrowings or loans for it to know the cost of funds, or the holding company is well capitalized, well funded, and does not need an external borrowing. That's the first difficulty that one could typically face in this kind of a situation. Again, a lot of these are more of practical challenges or issues. From the point of view of an examination, the assumptions, the data points will all be there in the paper. However, practically, these are the 2 or 3 key aspects that one would need to keep in mind. Hope you found this useful. If you need to reach out to me or reach out to any of us, please feel absolutely free to reach out to us. We'll be more than happy to help you. Please also do share your feedback. If you think this is going well, we will upload more and more of these short revision capsules, which will just help you in your preparations for the examination. Thank you. Have a good time. Take care.